Ever wonder how a private company goes public and trades on the stock market for the first time? What is an IPO, or initial public offering? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about IPOs. We're going to talk about what an initial public offering is. Can you as an individual invest in an IPO? And what are the risks involved with IPOs? Once again, I'll bring your attention to those like and subscribe buttons down below the screen there. If you want to make sure to catch future episodes of The Vault with Doug, Garrett, and myself, go ahead and click on those. Otherwise, we're going to go ahead and get to it here. Garrett, IPOs, initial public offerings, What are they?
Yeah, so as the name suggests, initial public offering or an IPO is essentially when shares of a private company are made available to the public for the very first time. So it goes live, so to speak, on the stock market. What is the purpose of an IPO? An IPO generally allows a company to raise a lot of equity capital from public investors. Obviously, before the IPO, that company is considered private. It's important to remember that before an IPO, that company had grown its business and grown its status really with a relatively small amount of private investors. Obviously, the original owner and founders of the company are investors. That could be an individual or a small group of individuals. They may have a few close family members or friends that are also initial shareholders. But oftentimes, when you're getting to the point of a company that's large enough to even go public, you've got several venture capitalists or angel investors that are also involved. One other thing to kind of keep in mind about an IPO is, in addition to it being, I guess, somewhat exciting because a private company is now going public and it can get a multitude of public investors, it's oftentimes considered kind of a passing of the torch from a leadership perspective. Very oftentimes, that original founder or group of founders is looking to pass on leadership to an official board of directors, which of course is regulated by the SEC. And it's oftentimes also kind of an exit strategy for those original founders or investors. They're essentially going to cash out effectively, many times, not always, from that initial influx of public cash that comes in. And then the responsibilities of the company will be led by some sort of board of directors. And oftentimes a new CEO is appointed as well, or shortly thereafter after the IPO.
Because every stockholder out there has a vote in what that board looks like and who's a member of it.
Absolutely. And you get multiple institutional investors, meaning like the brokerage houses, the investment banks, that the more shares that they own, the louder their say, so to speak, on the direction of that company. And you can see kind of some activism, so to speak, within that board of directors on, hey, we want to see a new CEO to influence the business in XYZ ways.
Right. Okay. So you're a private investor out there. You've got your IRA and you've got a brokerage account out there. How does just an individual like you or me, we're members of the public, initial public offering, how do we invest in an IPO?
So the reality is, if you're just an individual investor out there, you have a brokerage account, maybe an IRA, it can actually be very difficult for you to get your hands on shares of an initial public offering.
There's a limited amount of shares out there. There's a defined amount of shares. It's not endless.
Absolutely.
And then that's not
true of any stock. But in the underwriting process with the investment banks, they're going to determine what price are we going to initially offer and how many shares are going to actually exist out there in the public. Now, of course, as these investors start to line up, the brokerage houses and the investment banks and the institutions, so to speak, kind of get the first cut, right? Okay. And so even if you look at a stock that has traded publicly for many, many years, say Ford Motor Company, and you go to Yachting Finance and you look up the key statistics portion, you can look up what percentage of shares is held by insiders. That's typically the company's executives. What percentage of shares is held by institutions? Now you're talking the brokerage houses and the investment banks. And then thirdly, the last one is percentage of shares held by the public or outsiders. That's, just Joe and Sally Smith down the street. And you'll find that in most cases, the percentage of shares held by institutions plus executives can be as great as 50% or even more of that company. So nothing is different in an IPO in that those big investment banks and those private accredited investors are going to get the first cut. So as you as an individual, what's your easiest path, so to speak, to get your hands on some of these shares?
Right.
Most commonly, you will find that through a brokerage house. Let's say you've got a brokerage account at Fidelity or a Vanguard. Oftentimes, Fidelity, Vanguard, you name it, Charles Schwab, there's others out there, will get a certain percentage of shares that they then will offer to their clients who are on their platform. If that's the case, you may be able to get in line for your hands on some of these shares. The other way, maybe possibly less common that you could get your hands on it, is there's a mutual fund and an ETF out there for everything. There are specific ETFs and mutual funds that do specialize and focus on just IPOs. And so when IPOs go live, you can basically be a part of that mutual fund or ETF. Yes, you're not directly investing in that stock, but you're a part of an ETF or a mutual fund that specializes in IPOs and new offerings on the market.
Okay, so there's a limited number of shares out there. There's a lot of people that are in the mix to buy those. So as an individual investor, we don't necessarily have first pick at that. We got to wait in line.
Yes, we do.
With everybody else.
Unless you're a very high net worth individual who's an accredited investor, then you could potentially petition that investment bank to get kind of that first dibs, so to speak.
All right. And I'll just mention before we get to the last point about what kind of risks are involved in an IPO, because there certainly are. I will mention that as soon as somebody buys a share for the initial public offering price, they have every opportunity moments later to turn around and sell it, but that's now on the secondary market.
Absolutely.
All right. And that price could skyrocket because everybody else is out there in line trying to buy it.
Yep.
Couldn't get in on the IPO, but I'll go ahead and buy it on the secondary market. But in all likelihood, you're going to be paying a lot more for it on the secondary market moments later than you initially did. But there's people out there who want to buy IPOs, not because they want to hold on to it, because they want to sell it moments later at a higher price.
Absolutely. And I think you're tying into kind of
the risk. Yeah.
So what are some of the risks involving IPOs? First and foremost, if you're out there and you're considering investing in an IPO, know upfront that IPOs are notoriously volatile, certainly in the first day of trading. It can even last in the first several weeks or months of trading.
Takes time for it to settle out.
Takes time for it to settle out. Oftentimes, too, in the underwriting process with the investment banks, and this is all kind of part of the marketing for the public, is that the investment bank who underwrites the IPO, they have a pretty good idea of what their valuation of the company is on launch day, let's call it. Now, they're always going to discount the initial stock price to a certain percentage below their private valuation, which we never know. But what this does is this hopefully gins up excitement and attraction to the stock because it looks relatively cheap based on the pre-marketing that went out about the IPO to generate a lot of volume around it. So what you'll see is that, just like Brice had mentioned, in those early hours of trading, the stock price often jumps up quite quickly, but then people look to capture a quick profit that they've just realized in a couple of hours, maybe even minutes sometimes. And the stock price is just bouncing all over the place. That can last, as I said, certainly the first day of trading, weeks and months even. There's another kind of built-in piece of volatility that we also need to be aware of if we're considering an IPO, and that's called the lockout period. So what is the lockout period? The lockout period is dictated by the SEC as part of the underwriting process. And what this says is that those initial private accredited investors or those institutions that got their first dibs on the stock, they have to promise that they will not sell any of their shares into the secondary market for X number of days or X number of months. The shortest duration that can be is 90 days. It can go as long, however, as 24 months. Here's the problem, though, is that basically that's a ticking time bomb. And very often when that, let's say that 90-day period is reached, you'll see a ton of these institutional investors and these private investors unload their shares. Now, they can be captured in the secondary markets moments after that, but you'll see a steep decline oftentimes in prices once that lockout period has ended. And you're looking at these institutional investors looking to cash out on their own investment for a quick profit.
All right.
Sorry, just things that we have to keep in mind about IPOs.
Even more volatile than a stock that's been around for a couple of years in most cases. And like any investment, there's a certain amount of risk that goes along with it. And IPOs tend to be a bit more volatile in their price than a typical stock. If you're wanting to get in one, you need to be aware of that.
You need to be aware of it. And IPOs, like if you're just a pure traders tend to like IPOs because it generates a lot of price action, right? So you're looking for getting in at a price and having it, move, substantially up or down from where you got in on it. The issue is for most investors, unless you have the ability to monitor that price minute by minute, hour by hour, and you have the time to dedicate to truly trading the stock, not looking at it as a long-term or even a medium-term investment, the volatility can be too much to handle.
Right.
So unless you're kind of in the game of just that trading, almost day trading, or at least
minute trading, hour by hour trading,
or at least short-term trading, then that can be kind of something that you may not necessarily want to touch.
All right, fair enough. All right, so we've talked about what IPOs are, who can invest in them, how you can invest in them, and the risk that's involved there. Anything else to add?
No, I think we just wanted to give kind of a general overview of what an IPO is, what it means for the company. As far as that transition of leadership, we have to understand that in the background. And then also, too, as a potential investor, what could you be stepping into?
Very good. Well, thanks for that, Garrett. That's going to wrap it up for this episode of The Vault. Once again, there's those like and subscribe buttons down below the screen there. You can see them if you want to catch future episodes of The Vault with Doug, Garrett, and myself. You got to click on those. Other than that, that's going to wrap it up. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault.